Good evening, everyone. Topic of today's session is importance of asset allocation. For this, we invited Mr. Anand Venkitachalam, founder Karm Capital. Now, I would like to request sir to take the session forward. Over to you, sir.
Yeah, good afternoon, everyone. Can you see my slides?
Yes, sir.
Okay, so good afternoon, everyone. So I think I'll be covering today the important topic of asset allocation. So I think people will be communicating only through the chat, right?
Yes, sir. If they can raise their hands also, so I can allow them to unmute themselves and ask the questions.
Sure. So then what I'll try to do is maybe talk through this slide deck for maybe about 40 minutes so that I cover all the topic, and then maybe the last 15 to 20 minutes we can keep it for question and answers.
Sure, sir.
Yeah. Yeah, so I just wanted to highlight that I'm not a SEBI registered investment advisor. We are just a mutual fund distributor. So some of the aspects that I'll be covering over here are only purely from training perspective, and people should really take advice from their certified financial advisors before they take a decision. So this is more to explain the concept and tell the importance of asset allocation. I'm not making any particular asset or any particular buy or sell recommendation over here. Okay, so this is a little bit about myself. Basically, I am based out of Bangalore. For my initial 20 years, I worked in the technology field. The last 5 years is where I've been focusing on the fintech part of it, which also kind of motivated me to, get involved in the field of finance. And that's where, I offer also financial services and tools. That has been my passion. And I've also been, fortunate to write one book on the personal finance topic, which has been published by Penguin. So if any one of you all is interested, you could also, take a look at that particular book. So with that, I'll get started. So before I delve into the topic of asset and asset classes, I'll just do a very quick overview of personal finance so that we all understand.
So sorry to interrupt you. Can you
uh,
continue in both languages, Hindi and English both?
Hindi and English. So yeah, my Hindi may not be that great
Okay,
actually.
that will be good to go. You can continue in English.
Huh. So, or if you want, I can pause and you can translate to Hindi.
Okay, sir. Yeah. If there is a need, I will let you know.
Please. So I think please help me with that. So
Okay, okay.
wherever possible, I'll try to do Hindi, but my Hindi may not be that great.
It's okay, sir. We can continue in English also.
Okay, so that's why I'll try to go a little slow so that people can follow me.
Okay, sir.
So I'll start with the basic of finance or personal finance very quickly so that we understand where assets and asset class come into picture. So this is a very simple kind of a view. All of us will have some source of income, either it be employment, business, or some passive income. And also we will have some sources of expenses, right? Hopefully, for us to be independent and for us to enjoy wealth, we would want our income to be greater than the expense. And the difference between the income and expense is what we are calling it as savings. So with this, the key question that one has to ask is, can this savings be held in cash? So maybe you can just type on the comment box and tell me, can we do or we should not hold it in cash and why? Any takers? Yeah, Piyush says no. Haji also says no. Yeah, so I think the answer is right. The answer is a no because of this very deadly disease known as inflation. So what is inflation? Inflation essentially means that whatever products or services that we are enjoying today, if you enjoy it at a time later, basically, it will keep on increasing actually. So I have just taken one real life example of milk prices that has been there over the last 4 years. So if you can really see the per liter price has gone up from 38 to 48, or that itself represents a 6% inflation, which is typically what is the inflation in India. So basically, because of inflation, the prices rise. So if you held something in cash, then basically your purchasing power is going down. So in 10 years, basically your money power would reduce to 50%, and it will reduce by 70% in 20 years. So that is the reason. If you just hold your savings, actually you are also destroying your wealth. So then what has to be done? So essentially you have to convert that saving into an investment. So this investment is that very process where you take this cash and deploy it to some asset. And the basic requirement for investing in any asset is that it should give a return that is greater than inflation. Because if it is not going to give a return that is greater than inflation, then again it will kind of destroy the wealth. And that is the first motivation of what is investing. And for investing has to be done in different assets actually. I hope you're all with me. So then that is where first we will now what we will try to understand is asset classes, and then we will see how we could go about asset allocation. So typically I believe in stories. So if we have some stories that would typically help us to understand the topic better. So can you tell me what is the picture that I'm showing? Narayana, Vishnu, Lord Vishnu or Narayana. So anybody can take a guess what is the connection between Vishnu and the topic that we are talking of? Piyush is perfect. In the last meeting also, I was told the same thing, that he's the husband of Lakshmi, and anyway we want Lakshmi, so he's a very important character. I fully agree on that. Anything else? He's a spiritual asset. Okay. Any other takes? Take care of the world's work. Correct. He is the protector of the entire world. Multifaceted. That is correct. But also look at it from what we are going to study in the topic. From that aspect, what are you able to see? Multiple hands. Perfect. Beautiful. So human has two hands. He's having four hands. And can you focus in terms of what is he holding in those hands? Yeah. So if you also see, what I'm trying to highlight is even God, is using different instruments. He has multiple hands, and in that multiple hands, he's holding, different instruments. So God himself is doing a diversification. So just assume if he had a Sudarshan Chakra in all his hands, then even if a devotee comes to take his blessings, he will also get killed. So that's where the instruments are, very, very important. So some of you all have very rightly said. So on one hand, he has a chakra that stands for dynamic action. On the other hand, he has a Shankha for purity and calmness. Or then he has a Gada, which indicates strength and defense. And then finally, he has the Padma, the lotus, both in his hands and below his feet, which stands for prosperity and rootedness. And I'll come back to this later, but just keep this analogy. So essentially what we are telling is, and also we all know about the Templeton Fund. Templeton Fund is one of the biggest mutual funds in US, and the founder of that is known as John Templeton. So he had also made this very famous quote telling that only that investor need not diversify who is correct 100% of the time. And it's a kind of a paradox in that sense, because we know that nobody is right 100% of the time. Or in other words, what he is also telling is that we should not put all our eggs in one basket, but rather we should put it in different asset classes so that we build an inbuilt diversification in our portfolio. So like I think Vishnu had different instruments, so we also have different assets, and each of these assets have a different characteristic. When it comes to the financial asset, we measure the differences in terms of risk and reward, right? Reward means kitna return milega, Risk means कितना नीचे जा सकता है, or how much can I lose the money, because not in all activity the returns may be positive. So that is where we look at it from the risk return perspective. So if you look at it, the fixed income has the least amount of return, but it also has the least amount of risk. Then slightly higher is gold, followed by real estate, and followed by equity. And what we are going to do is trying to delve into these aspects in a great amount of detail. And pretty much all of us, we love things to be protective. We would like things to be very stable. So the very first instrument, that is the debt instrument, is like a fixed income mutual fund, or it could even be a simple instrument like a FD in the bank. So what we have seen in the last 20 years kind of a thing is the earlier, like I think when I took my first home loan kind of a thing in 1995 kind of a thing, the interest rate was 14%. So what we are seeing is, as the country, as the economy is getting stabilized, the interest rate typically falls. And in the last kind of 20 years, we see that it is in a tight range between 5.5 to 8%. So it has a very little volatility, and this kind of an interest is kind of guaranteed, that it is assured that you will get this kind of a money. So if that is the case, that if I put in a bank FD and the return is guaranteed, then why do we need other asset classes? Why not just put everything in the bank? Anyway, it will generate a return, and then we all can live peacefully. So can you tell me why this? What are the disadvantages of this asset class? Any take? Why do we need an asset class beyond FDs? Beautiful, because thank you. So typically, even if I get like a 7% interest, and if it looks like the inflation is 6%, but what really happens is the 7% will get taxed. And if you're at the highest bracket, let us say at 30-35%, your actual return post tax will only be like 4%, while the inflation itself will be 6%. So that's why basically what really happens is that you really don't get real return. So what is real return? Real return is basically inflation the interest minus inflation would be the real return post tax. So in that case, that number becomes negative. And that's why we need to look at asset classes beyond this thing. You're correct. In bank FD, also the guarantee is only up to 5 lakhs. But in mutual fund, you could put, which is fully protected by the SEBI rules and stuff like that. But still, it will not give you real positive return. And that is where people look for asset classes beyond debt. I hope you're all with me. So, and this is the chart. So if you had invested 1,000 rupees at the beginning of the year 2000, by today you would have made 5,873 rupees, or almost like 5.8x. And what we see by the study of the last 20 years is it typically grows at the rate of 7.25. But what we see is, as India also start becoming more and more like a developed country, this interest rate returns will keep on falling down. Like for instance, typically in countries like most of the developed countries, the interest rates are in the 2 to 4% range. So that's why this asset class will return moving forward will also keep going down. But this is how it compounds over a long period of 20 years. So the next one is the equity investment. And just for a representation of that, I've taken the Nifty 50 index. So if you look at the Nifty in the same period, what return it has kind of given, it has the debt gave 5x return. This has given 77 times the return. So it has given a huge return, and that gave a CAGR of 7%. But Nifty has given a almost double, right, at 13.8% CAGR. In that case, can I take all my money and put into equity? What do you feel? So debt we saw doesn't beat inflation, but then we have this instrument that is fantastic. It is really beating the inflation. Can I put all my assets into it? I think I see a lot of no's. So can you please write also why no? Because that would be more interesting to that. So somebody is telling more risk. Risk means what? Oh, okay, not all eggs in one basket. So you are taking care of my previous slide. But But even if you don't look at it from diversification, what is the other risk that you see? You can see that this line that goes in terms of when it went from whatever 1,000 to 77,000 times, it did not go in a linear way. Can you see that it goes up and it falls? And in the chart, I show three major areas. In the 92s, when the Harshad Mehta scam happened, the market itself fell by 47%. In 2008, when there was the world financial crisis, the whole index fell at that time by 60%. And very recently, during the COVID time, Nifty had fallen by 38%. So it is a highly volatile instrument. And what if you invested and if you needed to take out your money during the COVID time or something, your return would have drastically reduced. So because of the volatility nature of equity, we cannot put all our assets into it. And that is the risk that we carry. So volatility, as Piyush said, is the most perfect one. So then the next question comes, how should I invest in equity? Because it gives me a good return, but then it has a high probability of also giving low returns. So that is what we did was we did a kind of a study. So I'll take time to, please look at this chart. It's a very, very important chart. So on the first thing, what I'm telling is if I hold equity only for one day, what I'm essentially telling is 45% of the times it will give me a negative return. Similarly, if I hold this instrument for 1 year, what it tells is 57% of the time it will give me a return that is between 0 to 10%. But still, there is a 24% of the time it will give me a negative return. The light green indicates it's a positive return, but it's a return that is less than 10%. So it's almost like what you can say, it's almost only slightly better than the bank return, but it does not really beat. So what is the probability of that? So looking at this curve, the beautiful thing that you see is in the 5-year period, 7-year period, and 10-year period, essentially there is no negative kind of a allocation. Or in other words, what this chart tells you is if you hold an equity from a long-term perspective of keeping it at least for 5 years, or ideally greater than 7 years, then essentially there is a 80% probability, which is a very high probability that you will make positive returns. So equity is a very good asset class for giving the highest return among all the asset class. But the only constraint that it has is you should be willing to hold it for a longer duration. And this also shows you the year on year kind of in a year from that year's peak, how much did it fall? That is what the drawdown means. So it shows the volatility in every given year. And as you can essentially see over here, the nature of volatility of this index is such that on a year average basis, it goes down minus 20%. But and also once in a while, it will also go greater than minus 50%. But the way to beat that volatility is to hold it for a longer period duration. So that is what this chart indicates. The next asset that we have is gold. So gold has also kind of given almost like a 11x return, and it has given a CAGR of 13.9%, and it's a very good asset from a hedging perspective. So typically, even now, we are seeing that when the uncertainty in the world economy is there, or whenever there is a world crisis happens, world war happens, during all those duration, gold, rises quite significantly. But the only disadvantage that is there, I mean, I don't have the charts going back from 1980. I have only from 2006 because I'm pulling this data from MCX. But if you have seen the data that is there from very long time, you would see that it goes through a lot of periods where it remains in the same time correction band, or in other words, it doesn't move itself for a very long duration. So for instance, from 1980 to almost 89, for 10 years the price didn't move. Very recently, from 26 November 2012, what peak it had achieved, if you see the graph over here, it took almost 2019 for it to kind of recover or come back to the same peak. So gold also is a good instrument, but at times it goes into this time correction, and that's why it also has to be held for a longer duration. And then the last one is real estate. I've looked at the National Housing Board or the National Housing Index to look at it. There's not much of data available over here. But based on that, what we kind of see is it has given like an 8.7x return based on that index. But individually, some people may have seen a lot of gains because it also it's dependent on the locality. It really depends on the timing factor of it. But on an average, the growth rate has been 9.88% or close to 10% CAGR. Okay. So this is the nutshell summary of the four major asset classes. Equity has the highest return, but it also has the highest volatility. Debt basically is very stable, but it doesn't beat inflation. Gold is the next best in terms of return, but it also has to be held for a longer duration. And the next thing that comes is, the kind of real estate that is there. Yeah, I've just, kind of tried to summarize the same thing, what I was seen in charts in terms of words. If you really want to look at the long-term returns that you want to see, so typically equity return comes close to inflation plus GDP. So typically our inflation is about 6% and our GDP also would be around 6 to 8%. So if you take a 6% inflation and a 7% GDP, the return would typically come around 13%. That's how it comes around that number. Debt instruments are typically inflation plus 1 to 2%. That is the margin that typically is there. Gold kind of gives inflation plus 2 to 4%. And the same band is also true for real estate also. So real estate also is cyclical. Typically, it has a upcycle for about 7 to 10 years. Then it kind of goes flat like gold and then it goes. And in real estate, timing is very important. To be very honest, I have made a decent amount of money in all the three asset classes, debt, equity, and gold. But somehow I have not been able to crack real estate. But I know a lot of my friends who have a lot of big exposure on real estate, and they also do it very well, right? So these are the long-term characteristics of these asset classes. And what this also summarizes is that how much return you got in each of the calendar year for the different type of asset classes. So what would you conclude looking at this? So not only there's the asset class itself has some inherent characteristics of interest rate and stuff like that, but in a given year, different asset classes would perform. Correct? So that is what this chart shows. For instance, what it is showing is in the calendar year 2024, the best returns came from US equity and gold. But if you kind of look at 2081, the things that gave the best returns was equity and India equity, right? So I think Piyush, you are very right that as we are telling, the asset classes also rotate. So not all asset classes perform good at the same time. Neither do they perform worst at the same time. And the winners also keep rotating. I think that's a beautiful word that you have mentioned it. So with this understanding of the asset classes, now we will see how to use that so that we can make or we can maximize our returns. So one thing what we looked at is from basically two aspects of it. One aspect is diversification. And the second aspect is that given that in every year, all asset classes will not perform well, we have come to kind of a conclusion that, we need all these four asset classes in our portfolio. I think that is the conclusion that we would draw from a diversification perspective. You can just read through it. I've just summarized whatever I've said, that we have these four asset classes. Equity gives the longest return, debt the most steadiest, and asset classes move through cycles. For most of the asset classes like equity, gold, or real estate, long-term view is needed. And you need to blend these asset classes in a particular way for you to get diversification, but more importantly, also for you to get the maximum return. So now the next question is about how to build your own personal portfolio. Personal portfolio means what? It means in what ratio or how much amount, if I have 100 rupees, how much rupees should I put in equity? How much rupees should I put it in gold? How much rupees should I put it in real estate? That is what we call it as portfolio, right? So one thing from this winner all thing, if you see, we see that if I have some exposure to all the four things, I will make a better return. that should be intuitively understandable, right? Why? Because otherwise, if I just hold one instrument, there may be some year where I make positive return, and in another year I may make negative return. But if I am holding a basket kind of a thing, 1 year one asset class will perform very well. That will take up my portfolio much higher, and the ones that won't perform also, that will get compensated by the asset class that would perform. So that is why. Is it clear? If I hold all the four asset classes, not only would I diversify, but I will also get a higher return, because I will not be stuck with the asset classes where I will not be stuck with a portfolio where all the asset classes perform negatively, right? And yeah, I think Piyush, that's what you're telling, you're asking the question. That's exactly the next section that I'm going to try to address, is then how do you build a portfolio? So portfolio essentially is telling what could be the kind of allocation that one could do so that we get a better kind of a return. Okay. So this is one of the study that was done in the Financial Analyst Journal, published in 1986. And as I was trying to explain it to you intuitively also, so what it tells is, if you look at it at a portfolio level, then what it tells is asset allocation essentially decides 94% of the return. So that is why it is telling that diversification of asset is very important, and having the appropriate mix in the assets are also very key for getting the portfolio return. So again, there are multiple studies which would suggest this allocation in multiple different ways. But based on our study, what we have kind of seen as the allocation essentially depends on your goals, it depends on your age. All those factors essentially go into your risk profile. So as an individual, whatever is a risk profile, that would kind of decide, what should be your asset classes. And this is the kind of an allocation that, we suggest for people depending on their particular risk profile that is there. Yeah, sure. Okay. And so what are this is just a quick summary in what all forms they are available as instruments. So basically gold and real estate are available in the physical form. In fact, in India, most of the wealth is there in gold and real estate. While all the others, including gold and real estate, are also available in the digital format. So I'm telling one is known as the physical and the non-physical, or the digital aspect of it. Pretty much they are available in all forms, except that equity and real estate are not given by government, while government backed, there are a lot of fixed income products like the post office scheme, the public provident fund, the provident fund, the Sukanya Kalyan scheme, and other things. Gold also, the sovereign gold bond was there, which was government backed, but I think recently they have not been releasing any new series. So you can just maybe take a snapshot of this to understand what are all the different kind of an asset class or the instruments that are available for us to do. I think most of us are in the mutual fund. So the beautiful thing about that is mutual fund allows us to invest across all these asset classes by buying individual schemes, so that we can customize it according to the ratio that we want. Or we could also, hand it over that allocation to the fund manager, in which case, as somebody is requesting, Ananta Kumar, like a flexi cap or a multi-cap fund. Multi-cap fund, I won't suggest because multi-cap is only purely equity. It is only diversifying across the market caps. But really, a diversified product would be a balanced fund, in which case it diversifies across two asset classes, at least equity and debt, or a multi-asset fund, which typically diversifies across at least three, which is equity, debt, and gold. And some of the newer ones also have an investment into silver also. So if you don't want to do all this exercise, one easiest way to get the diversification is by investing either in a balance advantage fund or basically a multi-asset fund. Both flexi cap and multi-cap, please remember, they diversify only across market caps, but they both are purely equity products. So they are not flexi caps and multi caps are not diversifying across the asset classes. That's the only comment I would like to make. And this is a quick summary of the kind of the taxation typically that each of these classes have. If you want it as a quick reference, you could just grab a screenshot of it, but nothing more to add over here. So now, so that we remember these asset classes, so this is a quick summary that economic cycles affect asset classes differently. Diversification is crucial. As we have seen, the allocation or how much percentage we allocate to these assets decides our portfolio return. The best way to decide our asset allocation is to do a risk profile. And the risk profile based allocation, essentially what we are trying to do is balance the risk reward ratio for us, right? So not only are we looking into the reward part of it, but while getting a return, we are also trying to minimize the downside risk. Okay. So this is how you all can remember by remembering Lord Vishnu or Narayana. So the chakra, which is the dynamic action or the growth that essentially kind of indicates the equity kind of an asset. The Shanka, which kind of brings stability, is basically the debt product. The Gada, which kind of brings protection against inflation or worldwide events, we can look at it as gold. And the Padma, both in the hand and in the feet, which provides the foundation and the legacy, we can look at it as real estate. So next time when we look at Lord Vishnu's photo, when we look at these four of his instruments, we can also, very easily remember what are the four asset classes and how these four asset classes, like the Lord is also holding four different instruments. We also need to have these four asset classes, in our portfolio. So what I've also done is I've also built a tool. I mean, we can always do all these things in a manual way or by using Excel, but to make it very easy, intuitive, we have also built a tool that is known as the FinPlan tool, where all these aspects of doing your risk profile, suggesting the asset classes, telling where you stand, where your actual investment is standing with respect to this asset classes, so that you can do a rebalance every year. Everything has been done in this tool that we have built, including a lot of other features. If you want to explore, you could scan this QR code and try it out, this tool, or you can also check out the link, that I have provided on the top actually. So I think with that, I come to the end of my presentation. Hope you found it helpful. Thanks a lot for your time, and I would be glad, to take any questions that you would have. And the reason I gave a story kind of a thing is so that we can remember it, and it becomes quite intuitive for us to practice it. This thing. Thank you, Anand Sharma, for your words of encouragement. Yeah, so I'll open now for any question answers, and maybe you can ask question in Hindi. I'll try to answer it in Hindi. While presenting, I'm not that great in Hindi. Apologies for that.
Thank you, sir. I would request all the participants to ask their questions in the chat box.
Yeah, thanks, Piyush. My attempt was to keep it, very short and in a way that you remember, and didn't want to bore you with a lot of jargon section. If you would also like to get a PDF of this presentation, please scan this QR code that I'm showing over here and just share your email details there. My team will make sure that, you will be able to get it actually. So you can just scan this QR code and I could do it. So maybe can we get Ananda Kumar on the call, and so that we can better understand what he is trying to ask.
So we will try it.
Yeah.
So, Ananda, sir, actually we have portfolio reviews at our end. You can raise the queries from your CRM. We will try to sort it out.
Okay, so that feature is there in Nivesh itself. Excellent. Thanks.
Thank you, sir.
Okay, thank you. Thanks, everyone. Really appreciate your time.
Thank you, sir.